For decades, the global financial system operated under a clear and predictable structure. Debt expanded, money supply increased, asset prices climbed. This framework fueled growth and shaped capital flows around the world. Over time, the system grew extraordinarily large. Today, global debt has surpassed $300 trillion, far outpacing the productive capacity of economies. In recent years, governments and central banks injected trillions of dollars into markets at unprecedented speed, creating historic liquidity. Stocks surged. Real estate values soared. Risk was rewarded as confidence in the system remained strong. Within this environment, Bitcoin emerged, a digital asset born into a world of expansive monetary stimulus and abundant capital. Yet, systems built on continuous growth inevitably face structural limits. Debt has grown faster than economic productivity. Interest rates are rising. Deficits continue to widen. When the cost of money changes, capital reacts. Confidence, the invisible foundation of every financial system, determines the flow of funds. When confidence erodes, capital does not vanish. It relocates. Historically, it seeks neutrality. A neutral asset is one that is not tied to any government, political cycle, or fiscal policy. For thousands of years, gold fulfilled this role. In the modern era, many anticipated Bitcoin would become the digital successor, offering scarcity, portability, and independence from traditional monetary control. Both gold and Bitcoin are scarce. Gold increases slowly, approximately 1 to 2% per year, while Bitcoin's issuance halves every 4 years. Both exist outside the discretionary reach of governments, yet in this cycle, we observe divergence. Gold is reaching new highs amid rising structural pressures. Central banks are purchasing physical gold at rates not seen in decades. Meanwhile, Bitcoin demonstrates cyclical volatility influenced by liquidity, leverage, and market sentiment. To understand this divergence, we must consider two forces. The first is the structural or macroeconomic force. It operates slowly but moves the financial world over decades. Debt saturation, persistent inflation, geopolitical fragmentation, these forces shape the broad environment and influence capital allocation. The second is the technical or market force. It operates reflexively and quickly, responding to liquidity cycles, speculative positioning, and institutional flows. Bitcoin responds to both, while gold reacts primarily to structural pressures. Over time, integration of Bitcoin through ETFs, derivatives, and custodial infrastructure has increased complexity and short-term volatility. This does not invalidate long-term adoption. Instead, it reflects a phase of adaptation and market processing. Throughout history, capital rotates between regimes, from growth to preservation, from expansion to protection. During these transitions, markets can rise nominally while real purchasing power remains stagnant. Real returns, not nominal price appreciation, determine wealth preservation. When real returns compress, investors gravitate toward scarcity. Gold reflects immediate macroeconomic stress. Bitcoin reflects both innovation and appetite for risk. The critical question is not which asset will outperform next quarter. The critical question is whether we are entering a multi-year capital rotation event, one that could reshape the hierarchy of assets for years to come. Gold may lead during periods of instability. Bitcoin may lead during periods of renewed expansion. But the underlying forces driving capital are larger than any individual asset. Monetary systems adapt. Capital migrates. When structural pressures build, capital reallocates toward perceived durability. It does not vanish, it moves. Those who understand these forces can position themselves strategically, balancing hard assets, digital assets, and diversified investments to weather both volatility and uncertainty. Capital does not disappear. It finds new ground. And in the current environment, understanding the flow between gold and Bitcoin provides critical insight into the broader rotation of wealth in our interconnected global system.